there's not really much at the moment to create a really sharp jump in the markets. Now that could happen. We've got the employment report coming up. We've got a CPI report coming up here soon. And also earnings season is also really starting in earnest next week. So if we get a really, really weak employment report, which isn't great, right? Economically, a really weak employment report is not great for the economy. That means people are losing their jobs. That's not healthy, but it's good for the markets because that means the Fed will cut rates. That could lead to a fairly sharp jump in the markets. But here's what you need to know before the bell this morning. With this holiday shortened week, everything is very, very tenuous, in the markets. Markets did hit a new all-time high yesterday. S&P 1500. Now you can't really tell, right? Now you listen to the headlines this morning, and headline right now, CNBC: S&P 500, Nasdaq up 5 of past 6 days. New record high. S&P 5500. Absolutely true. We hit that yesterday, but I mean it is just barely a new high. So again, marginal new highs, not surprising. We're still just well entrenched in this kind of consolidation range at the moment. Very light volume here. Traders are gone for the most part. Markets are likely going to be up a little bit today, but we could open up strong, sell off. I mean, no telling what's going to happen. All markets are closed tomorrow for sure, and half a day on Friday. So really kind of stuck in this kind of sideways consolidation at the moment. But we continue to just run along that 20-day moving average. And as we continue to kind of make this advance, the market consolidated, the 20-day moving average caught up to the market. And the market kind of touched on that, bounced off of it, and that was that rally that we had yesterday. So this is just kind of the market action at the moment. That 20-day moving average continues to act as support. July tends to be a fairly positive month. So again, I would kind of expect this market to kind of continue this kind of sideways, slightly higher, trend in the markets. There's not really much at the moment to create a really sharp jump in the markets. Now that could happen. Again, we've got the employment report coming up. We've got a CPI report coming up here soon. And also earnings season is also really starting in earnest next week. So if we get a really, really weak employment report, which isn't great, right? Economically, a really weak employment report is not great for the economy. That means people are losing their jobs. That's not healthy, but it's good for the markets because that means the Fed will cut rates. That could lead to a fairly sharp jump in the markets. Also, a weak CPI report also would suggest the Fed may cut rates sooner than later. Starting to see expectations for Fed rate cuts, time to start to creep up here a bit towards maybe 3 rate cuts again this year. Markets kind of get a little bit ahead of themselves. But again, that's going to be some of the news that comes out at the end of the month, end of July. We've got the next Fed meeting. So the markets are really going to get trading off that Fed meeting here over the course of the next month. And as I said, July tends to be a fairly decent month for the markets. And remember, this time last year, and in fact, I just posted a chart on Twitter this morning comparing year-to-date returns from this year to last year, and they're almost identical. The market trajectory is identical at this moment. And what happened in July last year is we had a fairly sharp jump mid-July, and then that was the peak of the market and had that correction through October. So again, as we kind of get pre-election, we keep talking about this potential for a 5 to 10% correction. That's still very much in the cards. A very big deviation right now between the markets and this 200-day moving average. That's going to act like gravity here. So again, just continue to, don't be bearish, but just continue to manage your risk, rebalance your portfolios, take profits, do those type of things. Hedge yourself a little bit because as we get further into summer, that risk of that correction is going to rise. That's what you need to know before the bell this morning.